Hi everybody, Alex here from Expert Forex, and welcome to today's video. We're going to be looking at how to remove risk from a Martingale system, and you're going to be seeing actual trading results. So what we're going to be covering in this video is provide you with an understanding of how Martingale loss recovery method works. And we're going to see a new trading robot that will be launched later on in January 2022. We're also going to see the results achieved from actual trading using these concepts. And then I'm going to provide you with information on how you can trial the new robot for 2 weeks. And you're going to see some clever ways of reducing risk. Right, so let's get straight into it. Now, the Martingale system is actually a gambling system, and how it works, it's a very simple system. It basically says, okay, let's go to the roulette table, let's put $1 on red to win. So the casino spins and it lands on red and you have just won $1. You put another dollar on red and it spins, and this time you land on black, so you have lost $1 in that particular spin. So to recover that dollar and still make a profit, you have to put more money on, let's say, red. So you put more money on and you put $2 on the red. Now, why $2? Because if you put $2 on red, you will cover your loss of $1 and you will make a profit of $1. So the casino spins again and it lands on black. So now, all of a sudden, you have lost $3 because it's a 1 and the 2 there, and you've lost $3. And now, to recover those $3 and make a profit of $1, you need to put $4 on your next bet. And that is essentially how Martingale works. So whatever you've lost, you've got to cover that loss and add 1 to make sure that you win $1 on the spin. So if you lose again, you say, oh, I've lost 15, I now need to put 16. Oh, I've lost 31, now I need to bet 32 on my next bet, and so on and so on. Now, as you can see, the amounts grow tremendously and very fast, and you can see suddenly you're putting on $1,000 to win $1. It gets really unrealistic, and that's the biggest disadvantage of the Martingale system. A lot of Forex robots and a lot of traders actually use this system, and there are ways of getting around the big risk that's involved in this particular system. But it's important that you understand the basic system, because I'm going to show you some variations on this basic system that work incredibly well and prolong this ability to stay in a position where you can make a profit in spite of the market, as it were, going against you. So let's have a look at ways of taking considerable risk out of the Martingale system. Very easy. And we've actually written a robot that will trade the Martingale system for you using these principles. So firstly, when you're trading Martingale, and especially on a Forex way, there are gaps between your top-ups. So in other words, you enter a deal with a stop. Now, when that stop is hit, you then have to double your position in order to recover the loss and to still make a profit. And then you have another stop on that one, which is normally the same size, and on and on. Now, what I'm saying there, the large risk price ranges, means that the size of your stop. So if you are using stops that are, let's say, 10 pips, and you have a loss and you top up again, it is more risky than having a stop of, let's say, 30 pips or 20 pips. So the larger your stop size, the less risky the Martingale system becomes. So that's one way of filtering risk out of the system. Use reasonably large price ranges between the entries and the stops. So that's one way of doing it. Then obviously what you do is you start with a very small lot sizing. Start with 0.01 lot sizing, so that when you're doubling up and doubling and doubling, it lasts a long time. That's almost an obvious way of reducing risk, but a lot of traders ignore that particular part. Then And here's quite a critical one. Your risk return ratio. So in other words, when you go to a casino, you bet 1 to get 1. So your risk return ratio is 1 to 1. You're risking 1 to make 1. But in Forex trading, you can change that. You can actually risk 1 to make 2. Now when you do that, your ability to recover your losses increases considerably because you are recovering double what you've lost. So that is one of the areas that is very overlooked in the Martingale system is in Forex. And by the way, we trade this in all the markets, but you can change your risk return ratio. So again, my example, 1, if you're risking 1 to make 2, it makes a huge difference using the Martingale system. The next thing is to use a reasonably profitable system. If you've got using a profitable system or a high probability system that has a success rate of, let's say, 60%, your chances of having 10 losses in a row are highly reduced. So you must use a high probability system that will not produce 10 losses in a row. And I'll talk about that in a little later. Then time of day factors. The market certainly acts in different ways during a day. It sleeps just before the Asian market. Then it just wakes up gently during the Asian market. Then it wakes up a little bit more in the UK market. And then when the US market opens, it's really wide awake. But goes to sleep very quickly after that. So in each of those markets, the price action is slightly different and will provide better martingale type of opportunities than other markets. So the trader has to find those time of day times that are really good for martingale trading. Then the lot increase rate. Now in the example that I showed you, we increased our lots by 100%. So in other words, you lost 1, you increase it by 100%, and then you go to 2. So there's a lot increase rate that applies, and this can also impact the rate of recovery, the speed of your recovery, and also the amount of your recovery. So your lot increases may not be as systematic as the true Martingale system. It might be slightly increased or it might be slightly decreased, and because of your risk return ratios, you could actually decrease your lot sizing, increase considerably, and balance those two out. So there are beautiful ways of reducing risk when using the Martingale system. By the way, I hated the Martingale system for most of my trading career. But looking at these particular factors, and I've had a bit of time to sit at home and do some research, and I have come up with these particular factors to reduce the Martingale system. Okay, then the next one, which is one that I don't know of any traders that have used this to reduce this, but is use portfolios. Because when the one trading instrument goes into a slightly higher risk area, the others will back it up and support it. So you use a portfolio of trading instruments to balance your risk on a continuous basis. So you make sure you're not overexposed to the US dollar. You make sure you're not overexposed to the yen currencies, because those can really spoil your results if you have overexposure in those particular areas. You make sure that your indices are balanced, in that you're not putting all your money in the same kind of economy. And then a new development that's happened in the last couple of years is the use of 1 cent accounts. Some of these systems need quite sizable accounts, and the 1 cent account basically allows you to get the benefits of a normal account times 100. So in other words, if your normal system requires $10,000 to be traded, you can actually trade that system using $100. So it's 100%, you're getting 100% more value and safety out of using 1 cent accounts. So those are the ways that you can take considerable risk out of a Martingale system. We've built an EA, and here it is, and let's just go and have a look at some of. Here you can see the price gap. The price gap is the gap between price levels where we start topping up, and the topping, and depending on the size of that could be risky or not so risky. But there we've built it into the EA. We've got lots for the initial trade, mentioned that one before. Closure level, and that is basically your risk return ratio. So are you trading at a 1 to 2 risk return ratio, or 1 to 1.5% risk return ratio? That's what that percentage represents. And then your lot increase rate, which is basically if you want to accelerate your lot increase rate or actually decrease it because you are using a different risk return ratio. So it gets a little bit complicated, gets a bit balanced. And then here are the normal ones that we have where you can determine what time of day you want to trade. So the EA basically covers all of those, the first 6 points on my list here. And then portfolios, I'm going to show you an example of portfolios, and then the use of 1 cent accounts can even increase your ability to trade Martingale type of systems. So I hope that all makes sense to you, because we're going to have a look at some examples now. And here's an example of a Martingale system. You can see it's really done pretty well. There's been no drawdowns. You can see peak drawdown 0. The returns aren't great. They 5% over a 15-day period, but they are steady. We are actually trading a basket. We're trading portfolio of 10 trading items, which consists of Forex instruments and also indices and also gold. We haven't got Bitcoin in here, but we've tested on Bitcoin. Works pretty well on Bitcoin. But the idea is you use a basket of indices because you don't know which one is going to react in a certain way, and the more you trade, the less risk is involved. And here you can see this one has generated 27,000 on $500,000 and is a very small floating loss. And the incredible thing is, if you look at the actual results here, you can see all of the instruments, every single one is profitable. And what's interesting is the winning rate is fairly consistent for all of these instruments. So Martingale can be a very, very robust system. You just need a lot of money. Now, this is actually way too much. You can see with a peak drawdown of very little, this is way too much. You can most probably withdraw. So we're basically trading 50,000 per instrument, but you could most probably reduce this because you're using a portfolio. Now, here's another example. That was the 27,000. Here's a one, and this is actually the equity chart, and the blue line is your balance, your account balance, and the red line is your equity chart, which shows you that there's almost no drawdown here, and that it has produced 19,000, and it has a positive opening balance at the moment. Now, the interesting thing that you may not have noticed yet is the pips are negative. This system makes money when the price goes against you. That's a very important point. Can you see that the negative pips? Let's have a look at the previous one. Previous one was 14,000 negative, and this one is 20,000 negative in pips, and yet it's producing a beautiful return of almost 4% over 17 days. Those flat patches are the weekends. So there was a weekend, and a bit of Christmas in there. So that's why that's flat. But it's also showing you that it can make money under any trading conditions. We're trading most probably in the worst market conditions at the moment, and it's just floating up very nicely. So this EA will soon be made available to our premium forum members. They can test it for about 2 weeks. There's no beta testing. There's no optimization required. We will give you the settings. They're pretty standard settings. So all you need to do is go and test it and see and tell us what you think about this particular EA if you are a premium member of our paid forum, and you can go and have a look at this link to become a premium member. This EA is likely to be launched late in January, so we're going to go through a client trading period before we launch it, but we're pretty happy about the results. As you've seen, they're robust, they're very consistent. I didn't mention that in the last one. They're extremely consistent. Look at those winning rates up there, none are negative. So the consistency and the winning rates are pretty good. The other thing I must mention, let's say we're actually using a $500,000 portfolio, 500,000. If you are using 1 cent accounts, you would need only a $5,000 account to run this kind of portfolio. So that's the benefit of using one cent accounts. You'll still be earning your 4 to 5% return on your portfolio, and that's in every 17 days. So we're looking at returns between 5% and 10% a month, which is, if you relate that, you'll double your money over a year quite easily. But the big thing about this system is not to get greedy and just take those small gains as they come in. Now, I hope you've enjoyed this video, and I hope you've learned a little bit about Martingale and how you can make money using the Martingale system in spite of it being a loss recovery system. So one last comment, please do not make any inquiries at this stage. It is still in beta test mode. Internally, we're not going to set an external beta testing mode. We're going to go straight into client testing. So our paid for members can simply go and test the EA for 2 weeks. So from me, Alex Deploy, cheerio.